Thanks so much for tuning into this earnings interaction with the management of Sterlite Technologies. Ankit Agarwal, the MD, joins in. Remember, at the end of Q4, they had guided for about 25% revenue growth in FY23, citing a strong outlook, and they have finished Q1 with about a 20% YOY revenue growth and a sizable uptick or sizable inflow of orders as well. We'll figure out the margins, but let's put all of those questions to Ankit as he joins in on the show. Ankit, great having you. Thanks for joining in. Hope all is well.
Thank you, Neeraj. Yes, absolutely. Great to be on the show.
Thank you so much. So, Ankit, talk about the numbers. I mean, in a difficult environment, a 20% revenue growth seems commendable. What were the drivers? And is this the kind of exit that you're hoping for into Q2?
Yes, absolutely, Neeraj. So I think, what we shared in Q4 is that we do see strong tailwinds in terms of demand, both in Europe and US. And that continues to be what we experienced in Q1 and going forward. We had actually very strong order booking through the quarter, north of about 2,700 crores. And we've also seen that there's been very strong focus from our customers to continue to build out the networks for, at least several quarters going forward. So I think from that perspective, we do continue to see strong growth. We've also talked about growing in terms of our optical interconnect, in terms of our attach rate. That's also growing. And at the same time, we are very confident that with our volumes coming on stream, particularly in our US operations and to some extent in India, that will further drive revenue growth going forward.
Okay. So do you expect this steady state, a strong number, but a steady state 20% kind of revenue growth each quarter YOY, or could it be lumpy because of geopolitics as well as seasonality?
No, I think we have seen that even while there are global concerns on recession, etc., we continue to see very strong input and feedback from our customers that they are continuing to invest and scale up in terms of their fiber deployments. Even in India, for example, we are seeing on the back of 5G and probably a planned BharatNet kind of projects, we do expect strong demand in the coming quarters. So we continue to be confident on the revenue. I think a focus for us is clearly on the costs and reduction of the costs to improve the profitability.
Yeah, I was going to ask you that. QOQ, I presume there has been a margin improvement, and I presume because of revenue mix shift towards the optical business and towards North America. But tell us a bit about one, YOY, how did the margins compare? One, and what are you doing about the input cost pressure? Because I'm sure it's hurting everybody in India, and you would not be too different from there.
Absolutely. I think it would be better to compare the margins on a quarterly basis, because I think there have been these specific events that we've spoken of. One of them has been the container cost. As a vast portion now of our sales is in Europe and US, almost I think north of 80% of our overall optical sales. So we've been disproportionately hit by the cost on containers. While we have seen some reduction of that in the past one quarter, the absolute amount has still been higher because of the sheer volumes in this region. The second has been linked to crude. And so I think to that extent, it has been hovering in this $110, $120 range. So to that extent, that continues to be one important cost factor in terms of crude and related elements. So I think on the cost part, we are still looking at some improvements in the quarters to come. We are continuing to work on operational efficiency improvements, which I'm positive will come through in Q3, Q4. So all in all, our stated strategy of focusing on the key markets has worked out well for us. We continue to see some good volumes in those markets going forward. We're very focused on optical interconnect attach rate improving, which will further improve our margins. And then I think the third part is clearly from a working capital and cash part. That is a primary focus of releasing that in terms of reducing our working capital.
Okay. So Q2 may not see material improvements, material changes from your own admission, but Q3, Q4, by virtue of the internal things, as well as maybe if the container costs cool down even further, if they do, then you might see material impact.
Absolutely. And that's exactly what we spoke of at the end of Q4. That we do see that probably Q1 and Q2 will still see some of the market absorbing some of the costs and STL itself working on reducing the cost. But we also expect that some of the price increases we have initiated both in US and Europe will start coming across in our P&L towards end of Q2, but certainly into Q3 and Q4. So I think that will be a positive lever. And then as we see some of these container costs and other costs reduce, that should further help improve the EBITDA profitability.
Sorry, did I hear you say price increases in the key markets?
That's right. That's right.
Oh, okay.
So we have been in discussions with our key customers, both in US and Europe. We have had some successes, but by nature of the negotiations, from when we negotiate to it impacting our P&L, it typically takes between 1 to 2 quarters.
Okay. One quick point around what is the receivables situation at this point of time, Ankit?
Yeah, so overall, what we're looking at is breaking up between the businesses. Today in India, the services, we have some portion of receivables from the government, and then we have from the private sector customers like Airtel, etc. So we are working on those very diligently to collect the receivables as well as ensure very smooth cash going forward. On the global part, we don't see any challenges right now, both especially in Europe as well as US. We are seeing a consistent flow of cash based on whatever is due. So I think the major focus for us is to ensure that our collections on the India part get structured, which I'm again confident Q2 and into Q3 onwards, that should improve.
But quarter on quarter, has there been an increase in the quantum of receivables?
Yeah, so what we have seen is 2 or 3 elements. One is because of our growth in North America in particular, our working capital has increased by about 150 crores. We have also seen increase in what we call contract assets. So where we have unbilled revenue to then be invoiced and then collected. So that has also gone up by north of 100 crores. So these are the 2 elements which we are working towards reduction.
So that's on the global side, and on the Indian side, you're working on the receivable collections from.
Yeah. Contract assets are linked to our services business. So typically governments on BharatNet or other government projects where we're looking to reduce that.
Okay. One quick update. I mean, a few quarters ago when we had spoken and then we were speaking to Anand, there was this whole flurry of smart cities and the ordering thereof, which could benefit you tremendously. What's the status on that? I mean, how is the movement there and what is your role out there?
So I think our biggest focus we've shared also last couple of quarters is strategically we are more focused in India on the private sector and reducing exposure to the government, with one exception being the BharatNet, which could be north of a $10 billion opportunity for STL. So I think that's one part that we're looking at closely, but otherwise disproportionately focus on private sector in India. We have also taken our services in the UK successfully, and even that is with the private sector in the UK.
Okay, so last question, Ankit. Actually, 2-part question. One is, where do you see the average margin picture? What do you see the average margin picture to look like? I know it's a difficult question to predict considering the volatility, but still, is there any internal target? And 2, would you need to raise any kind of fundraising over the course of the next 9 months as a part of the role of either acquiring further stake, as you had said that you would probably acquire in the Sterlite Tongwang Fiber Company, or some other acquisitions that you may need to do?
Sure. So I think on the first part, we continue to stick with our guidance. We talked about the business units and the optical side being between 20 to 22% EBITDA margin and low teens on the services margin. So that's the primary focus. I think some combination of that, typically we see about 70% of business being on optical and 30% on services. So some combination of that should get us to around 14-15% EBITDA overall STL. This I'm talking towards the exit, as I said, towards Q3, Q4 as the profitability improves. So I think that's one part. I think to your question on the cash part, I think overall we are very confident that with some of the improvements structurally on the internal processes, internal working capital, and our conversations with customers, we do believe that we'll be well placed in terms of our internal, generation of cash for a growth. We have recently also acquired 25% of our joint venture stake from TG. So that is also something which will further help us ensure that we have full visibility of our optical manufacturing. We have taken an enabling resolution of up to 1,000 crores. So that is something we'll continue to evaluate. If the requirements of funds and the right market conditions, we'll evaluate that.
But it doesn't stand to at the immediate time. In this quarter, you will probably not do that, would you?
No, we continue to evaluate it. We don't have any immediate plans.
Got it. Great. All the best for the quarters ahead, Ankit, and thank you so much for speaking to us today.
Thank you.
And viewers, thanks for tuning into this conversation.